Hello, welcome back, everyone. Today we're going to have a very special treat, very special guest. My name is Seewing Yi, of course. I'm from the Yi Real Estate Network. And my special guest is no other than Amanda Han from CPA, from Keystone CPA. How are you, Amanda?
We're doing great. Really excited to be here, Seewing.
Yeah, I know you have a very busy career, very busy schedule, and I appreciate your taking the time to connect with my network. Amanda, just to reiterate, my I own a real estate investment club, and here in San Francisco Bay Area, been doing it for almost more than 20 years now. Evolved over the years, and I'm sure you work with similar real estate investment clubs all over California, and for that matter, all over the U.S. So our core philosophy is we take our California investors. Around 50% of our investors are Silicon Valley engineers from San Jose, and the remaining 50% are healthcare professionals, management levels, California investors who have W-2 jobs who are very busy. So all these years, I guide them through out-of-state market. Back in the early days, we do capital properties in Las Vegas, in Boise, in Phoenix, and even in California. But those days 15 years ago are long gone. So cash flow wise, it's just like something you are accustomed to working with your investors. Our California investors, they're going out to the Midwest for turnkey high cash flow properties and South and Southeast Florida, Texas, and North Carolina, a few other places. In Alabama also, we're pivoting those markets. Anyway, so we have one investors that are working with our group. My members, I'm just sharing with you, Amanda Han and her group has been doing a lot of great work for real estate investors. You guys are specialized in real estate investors. Not easy to do to say that because most CPAs, in case you do not know, they do not specialize in real estate investors. You and Matt have done a lot of podcasts on a weekly basis. You get invited to major conferences all over the country. You do a lot of speaking arrangements to a large audiences all over the country. So you guys are very busy. Really nice to connect with you. To be part of our investors could be part of your team as a part of the financial team of professionals that can guide them along long term to achieve financial success. So thank you, Amanda, for creating this referral relationship.
Yeah, no, excited to be here. I think you're right. It's one of the reasons that we started our firm initially is because we realized that everyday investors just really don't have access to good tax planning. When Matt and I used to work, we started out our careers in Big Four public accounting. And when we were there, we serviced like very large real estate investment firms and very high net worth individuals. And for those people, tax planning is like a normal part of their life. They know to call or email us whenever transactions were happening and they're thinking about different business decisions, and so that they could get advice on like how to do it in a way that helps to minimize taxes. But when we started investing in real estate ourselves personally, and we started going to real estate meetups like your group and different groups, similar groups, is when we realized like just everyday investors don't think that way. Sorry. The everyday investors don't think that way. They're not thinking in terms of how do I save on taxes. It's really been a passion of ours to really try to educate everyday investors on how we can use real estate to build wealth faster and to save on taxes. And that's not just for the super wealthy. We all play by the same set of rules.
Absolutely. Yeah, that's a very good. Yeah, there's a tremendous need out there for professionals like you guys who understand the everyday challenges of the mom and pop real estate investors out there. And because, like I said, these full-time people, professionals, they don't have enough time to learn everything. So they leverage and they delegate a great trusted quality team, asset protection attorneys and tax professionals like you guys and different other financial professionals. So yeah, thank you, Amanda. Let me go through some topic I would like to discuss. We only have approximately 30 minutes. We can talk all day because there's so many great topics that the investors need to know. But we take it slow, little by little, right? So yeah, some of the topics we should go over are the following. Let's go over a little bit about from a high level, everything from a high level, of course. We can start off with passive loss limitation. We'll go through the first category, active investor profile, people making less than 150K adjusted gross income and how much passive loss they can write off. Then the next group of investors that we work with mostly people, my investment group work with people easily make more than $150,000 as adjusted gross income. So a lot of my investors, they kept asking me, like, what kind of past losses write-off I can do, especially I cannot do rep status, especially when I do not qualify, at least not just yet, to do the real estate professional tax status. Am I being left out because all the potential passive loss write-off for my rentals are suspended indefinitely for the future years? What's in it for me for the high income earners, right?
Yeah, and that's really an interesting point because I think that's an area oftentimes of confusion for people, right? People, and even CPAs, a lot of times you'll hear CPAs say there's no benefit in investing in real estate if you're a high income earner and you're not a real estate professional. And so we hear that a lot from investors and also from CPAs too. And it's really important to understand that when you hear something like that from a CPA, that's not necessarily 100% true. So when a CPA says there's no tax benefit in investing in real estate, what they're talking about is that you can't use rental losses against W-2 income. That's pretty much all they're saying. And while that is true, tax savings is not just looking at one specific thing. For all investors, regardless of your income level, you could be making $200,000 or $2 million. And even if you're working full time, not doing real estate is just like a side hustle for you, right? Not a real estate professional, not married to a real estate professional. All of us can use rental losses to offset different types of passive income. So the question we get a lot is, what is passive income then? Right. So first and foremost, passive income is income from rental real estate. So if I have a rental property with tax loss from write-offs and depreciation, I have another property that has taxable rental income, they can always offset each other, no limitations. Eventually, when I sell a rental property, I can always use my passive losses from this year and previous years to offset taxes on the gain on sale of real estate. And what a lot of people may not know is actually in the year I sell a rental property, if I have an overall loss, like meaning I made a bad investment decision because cumulatively I've lost money, that loss, it becomes an ordinary loss, which means it offsets W-2 income as well, even though you may not be claiming real estate professional status. We have a lot of clients who are savvy investors. They might be an engineer. They invest in real estate. They also invest in other startup businesses like a restaurant, or we have someone investing in a museum. A lot of those types of investments are passive income generators. So absolutely, if you have $100,000 of passive income and you got some rental losses, they can always offset each other. And so really important to understand that for real estate investors, high income earners doing real estate on the side, there is a benefit to investing in rental real estate. The question simply is, when do you get to see that benefit?
Yep.
Some of you get to see it today. Some of you get to see it 3 years from now. Some of you get to see it 5 or 10 years from now. But there's always a benefit to real estate investing.
I agree. You answered a lot of my questions, and we're going to dive deeper into some of those subsections, some sub questions later on this podcast. So let's go over the first component. Let's spend 7 to 10 minutes. The first category is, quote unquote, from the IRS definition, active investor, meaning if you're single, if you make $100,000 or less adjusted gross income, you are able to write off on the current year up to $25,000 of passive losses. So that's a very nice bonus to have. So let's compartmentalize this first group: 100 grand single. If you're 150K married filing jointly, you can write off $25,000 passive income if you make 150K AGI or AGI income. Am I right so far on this first category?
Yeah. And what active income, a question we get a lot is like, what is active, right? How do you get to the active status for rental real estate? It's actually pretty easy. There's not really a whole set of requirements. Most people who own rental real estate are able to be able to show it as an active status, even if you don't self-manage your properties, has nothing to do with real estate professional status.
Yep.
I would say then the only time that we don't get that active status usually is when you're investing in syndications. So if you're like a high income earner and you're like investing in a syndication, those usually are not eligible for this $25,000 tax loss because the syndications are set up where you cannot be active, right? That's the definition of the syndication. But yeah, for people who just own a rental property out of state, like what you're saying, if I make $100,000 on my job, I own a turnkey single family home in Florida. Odds are, if I can have enough tax losses, I create enough tax losses, I can use up to 25,000 of it to offset my W-2 income. And if you think about it, someone who makes $100,000 of income and can avoid paying taxes on $25,000 of it, that's pretty life-changing, because that just means there's more money for them to reinvest into real estate. And so I sometimes people tend to think, like, I don't make that much income, maybe I shouldn't do tax planning. I'm going to wait until I make $1 million. But here's a really great example of how even when people make less money, it's maybe even more impactful as a percentage.
Yeah, absolutely agree. Let me give you a further example. I'm just giving you a high-level calculation. I'm not being precise. $25,000 passive losses. We're talking like 3 or 4 $200,000 out-of-state rental property, cash flow properties, right? That equate to around maximum 25K, with somebody that earning 100 grand or 150 grand getting that limitation annually. So therefore, if they're a tax bracket, let's say federal tax bracket of maybe 15 to 20%, would it be fair to calculate 15 to 20% federal tax rate multiplied by the $25,000 passive losses? And that could be the net savings on an annual basis, given this scenario. Would there be a fair calculation?
Yeah, for sure. And I think there's also, like, when we say tax loss, we use up to 25,000 of losses. People are like, why do I want to lose money? But you're right, we're not talking about losing money. In fact, ideally, if you're making the right investments, it's cash flowing, it's appreciating. But when we talk about write-offs, right? Can we write off our travel to Florida to close on the property? Can we write off any real estate education we're taking? Can we pay our kids to help out in the real estate business? And then, of course, depreciation and cost segregation. If we can create the paper losses to accelerate it, that's where that loss comes from. And yeah, a lot of times, like if you can save $5,000-$10,000 a year, that could be a down payment. After a year or two, that could be a down payment on another property.
Yeah.
You kind of repeat that strategy over and over again.
Yes. Yeah. Very good point, Amanda. Let me conclude with this first category of tax rule, the active investor rule. As I understand from a high level, that people making less than 150K, single or married, filing jointly, they can get up to $25,000 passive loss limitation to offset against their active income. And no reps that are no real estate professional tax status needed, as long as you make some kind of decision to the property managers to give them some kind of authority to fix something that qualify as an active investor. So that deems you able to write off up to 25K. So this rule is fairly simple, all right? So you agree before we go on to the next topic? You pretty much agree? Yeah. All right. Oh, by the way, if that individual or couple making less than 150K, if they can buy more rental properties, nothing wrong with that. If they exceed $25,000 passive losses, if they own 6-7 rentals, they're going to exceed, most likely, $25,000 passive losses. Then any excess will be suspended indefinitely toward future years to potentially offset future passive income from their taxes. Am I right?
Yeah. And one of the strategies in that scenario would be, let's say you are someone who makes $100,000 or less and you bought 6 rental properties. One of the things to consider is maybe we'll only do accelerated depreciation on 1 or 2 of them, right? We want to do just enough to get to that $25,000 tax loss we can use. And then maybe properties 3 and 4, I'm just going to do regular depreciation. In the following year, if I don't buy any more rentals, I can maybe do cost segregation on those other properties. And then you stagger it so that you're not creating a huge passive loss that you can't use, but you're being more strategic in terms of when do I do the cost segregation on which property, so I optimize my tax savings year after year.
I love what you just said, Amanda. You know how often over the years I run into my members, my investors, they say, oh, I don't need tax planning. I'm only going to buy 1 or 2 rental this year. But they told me their goal. They told me they want to buy 10 rental property in the next 3 to 5 years. Then I said to myself, that's more the reason why you should hire a tax professional to plan your strategies ahead of time. So because advanced tax planning is critical, right? Anyway, hiring somebody like you early on is even more important when they have a higher goal of buying multiple properties. Yeah,
Yeah.
yeah.
And I think it's really what you just said is really important for people to understand because I think all of us we tend to downplay what our goals are. And when we like you said, I only plan to buy 1 or 2 rentals a year. 1 or 2 rentals a year is a pretty hefty goal, right? It's really doing a lot to build your net worth and to build your empire. Or people say, I'm only starting out and I only own 6 rentals. But again, 6 rentals is quite a bit. So the question we get a lot is like, when should I do tax planning? Right? I only have X number. I only will buy X number. And so what I typically tell people is someone who should do tax planning is someone who's looking to grow or scale their real estate portfolio, at least for our purposes. That's what you're looking at. It's not so much like how much money you're making. If you're somebody making $2 million a year at your W-2 job, you never want to invest it, you don't want to do any real estate, then it's not a good candidate to do tax planning with us because there's not much going on. It's just that W-2 income. But if you're someone making $100,000 and you want to buy just 1 rental per year, in your example earlier, like, yeah, that could do a lot to save on taxes, even with just 1 rental property.
Yeah. Yeah. Okay. Before we get to the next category, very good point. Before we get to the next category, as I understand, yeah. So cost segregation. I know we don't have time to talk about cost segregation and bonus depreciation. Yeah, I love your creative strategies. When if you have 3 or 4 rentals, you can use one of those rentals to do the cost segregation, so you can get the $25,000 passive losses as early as possible. So that's require a lot of strategic planning, like you said. Yeah, I get it. I see the value of a tax professional like you guys can bring out things that normal investors may not have thought of. So great point.
Yeah.
Okay, the next category we're going to talk about is California. You and I live in California for many years, and most of my investors they make way more than 150K. Even one individual working as a Silicon Valley engineer, I have a lot of engineers within my group. They could easily make 150K as a single individual, and a lot of investors they make combined 2 income like 300, 400K. And I've been frustrated over the years that I'm unable to convince them, see a CPA to go over your tax planning and go over the short-term tax loophole, go over the cost segregation, go over real estate rep status and all those kind of things. But anyway, my frustration hopefully is over now that we hook up with your firm. Anyway, so next category, we're going to talk about individuals, single or married, or making more than $150,000 adjusted gross income. And the common misconception is that, oh, I can't write off anything because when you make between 100 and 150K, there's a phase-out deduction, $2 for every dollar. And we make more than 150K, all your past losses will be suspended indefinitely for future years. So the common misconception is my investor come to tell me, oh, in that case, I'm not going to see a tax professional. Why? I'm not getting immediate current year benefit. Everything is suspended. Might as well not invest in real estate. So how do you overcome this common misconception from real estate investors, especially newbies?
I think it's a lot of the same thing I was sharing earlier, right? We can't just take a limited view of rental income against today's W-2. We want to look at using tax benefits against rental income itself. So I would argue if you're someone who's paying 37% taxes on your income in Silicon Valley, if you made $30,000 of net rental income, you're going to pay 37% taxes on it. And so it is important to make sure you have the right strategies to, at a minimum, pay no taxes on the rental income. For someone's like, hey, I made $1 million last year, I paid tax. This year I made $1.3 million and I only paid tax on $1 million. That's definitely taxes saved. And it's important to understand that rental income is also at our ordinary tax rate. So we want to do what we can to get that down as close to zero as possible. We want to be tax efficient. The other kind of common misconception people will say, you alluded to that, is why do I do tax planning? Why do I write off things? Because I'm not going to get a benefit anyway, right? Why track my car expenses? Why claim a home office? I'm still going to pay taxes on my W-2 income. The reason you still want to track all those and claim them is because it creates more passive losses for you. And as I mentioned earlier, passive losses, even if it doesn't offset your income this year, it absolutely offsets your income in a future year against rentals, against capital gains from the sale of rentals, or against W-2 income when you sell. And it's easy for a CPA and even an investor to just get lazy and say, I'm going to get a benefit today. Let me just skip on all that stuff. Just understand that when you're skipping on the strategies and the deductions and claiming it correctly, you're also giving up tax benefits permanently. Because if you had a home office and car expenses and you don't claim it this year because you think it didn't matter, you're never going to see the benefit. Alternatively, if I claim it, even though I'm not seeing a benefit this year, it's like a piggy bank. I'm saving it up for so that in the future, when I do sell properties and I do have income, then I don't have to pay taxes on it because I have this accumulated losses that I've strategically created over the years.
Oh, absolutely. Made total sense. Let me further that point. Let's say all the suspended passive losses will be carried over from year 2, year 3, year 4, year 5, year 6. Let's say you have 7 to 10 rentals, someone have, and the suspended passive losses are cumulatively increased to like 100,000, 200,000 of suspended passive losses. And during all those years, you're unable to write off anything because you don't meet you're still subject to the passive loss limitation. What if some point in time, one of your rental, you sell it, and you may not need to pay any capital gains because you may not need to do any 1031 tax deferred exchange, because when you sell one of the property or more, whatever the gross profit is subject to capital gains, because one accumulates so much passive losses, the passive losses itself can offset any kind of capital gain you pay when you sell one rental, and you don't even need to do 1031 tax exchange. Am I right?
Yeah, and I think investors tend to kind of default to 1031, right? Because we all know what it is, and people will say, "Oh yeah, I'm going to sell property. I'm going to do a 1031 exchange." But yeah, for a lot of our clients who are not real estate professionals, and I guess everyone in general, before you even think about a 1031 exchange or get paid for a 1031 exchange, the first thing we want to know is what is going to be your taxable gain. And taxable gain, like you said, is going to be the gain from the property minus whatever passive losses you have to offset it. And so it's not uncommon for us to see a client who has appreciated properties in California. They want to sell those and get into properties, let's say in Florida, for higher appreciation and cash flow. And maybe a 1031 exchange is detrimental, right? Because if I did a 1031, I'm just having carryover basis versus if I sold, and I can use my passive losses, I'm using the new money to buy my Florida rental properties. Now I have higher cost bases. So the tax strategies, I think, for a lot of people, like we've heard about them, get a general understanding, but how it actually applies in real life, how does it apply to your situation or this specific transaction? That's where the fun is, right? It's not like a one size fits all solution.
Absolutely, absolutely. Okay, just to reiterate what you spoke about earlier, when you file a Schedule E rental income on a schedule, the rent itself, if you do not deduct anything, the rental income itself is subject to your ordinary taxation tax bracket. So if you in the highest tax bracket federal, let's say 37%, I don't know, if you do not claim any depreciation, if you do not claim monthly or annually rental income minus mortgages, taxes, insurance, property management fee, vacancies, or maintenance, you're going to be paying rent at highest federal tax bracket if you're a really high income earner. And if you live in California, you have to pay the franchise state tax up to 13% state tax, in addition to the federal tax, 37 highest federal level. Half of your money, half of your gross rent could be paying for taxes. Luckily, even if you cannot claim depreciation, even if you cannot claim passive losses because you make more than 150K, you can still claim do the passive loss. You can write off passive losses against passive income. You can still claim all those little travel expenses, home office, transportation expenses, and taxes on your income property and insurance and all that. That alone, even without depreciation, can reduce your rental income subject to ordinary taxation. So that is a benefit as it is, even without depreciation. Am I right?
Yeah, that's a big switch for a lot of people, right? It's like if all I've ever earned was W-2 income and there's basically no write-offs against W-2 income, versus now that I own rental real estate, I can finally start to shift some of these personal expenses into legitimate business deductions, right? So claiming part of my home office that I use to manage my properties. When I use my car for my rental real estate business, and it's starting to be able to shift some of those things into deductible items against rental income, whereas before, generally none of those are deductible against W-2. And I think it's really important for people to understand that when it comes to the IRS, generally real estate investors are treated as business owners, which means when you hear about all the tax benefits of owning businesses, that also all applies to real estate investors, because real estate investing in rental properties is a business activity, right? It's not a hobby. Nobody buys real estate for a hobby. It's too expensive of a hobby. So most of the time it's done as a business. And when we say business, we don't mean like an LLC or corporation. We just mean in the business of being a landlord, right? Investing in rental property.
Right.
I know that earlier we talked about you had an example about, hey, I sold a rental property for a huge gain. I have all these passive losses. Also, really important to understand that passive income is not just from rentals. It's not just from the gain on sale of rentals or rental properties, but a lot of other businesses that we invest in. We have a lot of our clients that are in the medical space, if they're physicians. So you might have like a doctor who also invests in a medical imaging center or a laboratory or something like that. And those oftentimes provide really high cash flow and high passive income. And so for those people, investing in rental property is even more beneficial, right? Because not only are they using those depreciation and write-offs against the rental income, but also start to reduce taxes from these other passive income that they generate too.
Yeah. Even if those individuals or do not qualify for the rep status, resident professional status, they can still deduct all those passive losses from the other businesses, like you just mentioned, not just rental real estate, right? Yeah, good point.
Yeah, the key thing we're looking at is whether something is active or passive. That's actually a mistake area we see more often than we would like. Because I think for a lot of CPAs, maybe our natural tendency is to have something be non-passive, right? Because non-passive so far sounds like a bad word. I don't want it to be passive. I want to use it all. And so I think for a lot of CPAs, the tendency is to say, oh, I'm investing in this. Maybe let's make it non-passive. I'm doing different investments. Let me make it non-passive. But again, taking a holistic look and saying, hey, John Smith here, he's invested in a medical imaging center or an X-ray center. And maybe I want him to be passive because John also owns a bunch of rental real estate, right? So those are the little things that, again, client by client, but if you have to take the time to think about it and plan through it to make sure you actually get the tax benefit of it rather than just blindly saying this is a one size fits all, always works, never works.
Yep, absolutely. Okay, I think we only have about 10 minutes left. I really appreciate your time. Let me ask you a couple more questions, then we'll conclude. Let's go over the scenario. High income earner making more than 150K. Okay, they understand the passive losses will be carried forward indefinitely to future years. And when as they accumulate more properties, should they do cost segregation? It costs money. It costs like $3,000 to $4,000 to do a cost segregation. If you rent a property you bought is only $200,000, you may not want to pay for the cost.
Here's the benefit: is a cost segregation study is basically our ability to calculate depreciation differently. Rather than taking the regular 27 and a half years depreciation, we can accelerate it to take it faster, which means we have a larger depreciation expense this year. The beauty of all this is there's so much flexibility and control we have as real estate investors, right? So you're not required to do cost segregation. And even if you decided to do it, you can choose which year you want to do it. And so two questions we get: should I do it and when should I do it? Okay. So first question first, should I do it? It depends. You should do it if you are going to save taxes currently on it. And so that kind of goes back to your question, like, okay, well, I have a bunch of properties. Should I do it? The answer is, can you utilize it? Are you a real estate professional? No? Okay. Do you have other passive income from your rental properties? If not, then maybe no. If yes, then sure, I would consider it. And the third thing is, do you have other passive income outside of real estate? Right? So am I invested in other things that generate passive income? And if the answer is yes to any one of those, then maybe I'll consider it. Why? Because if I can create more tax benefit that I can use today to save on taxes. If the answers to those questions were no, then I wouldn't do a cost segregation right now because I'm not going to accelerate something if I don't get a benefit. I would just wait to do that later. And that kind of leads into the answer to the second question. When should I do it? You should do it in the years where you actually get a benefit from it. A misconception people think is I have to do the actual study in the year I want to use it. And that's actually not true. The time to do the actual study is any time before you file the tax returns in the year that you want to use it. So right now we're in 2024. If I determined that I would get a benefit on my 2023 taxes, if I were to do it, I can still do the cost segregation study now for the 2023 year and be able to save on last year's taxes. So a lot of flexibility in terms of whether and when you do the actual study.
Okay, so you can go backward 1 year for the cost seg.
You can go backwards. You can go back any number of years. So if 5 years ago I bought a bunch of rental properties, this year I'm finally qualifying as real estate professional, then I can do the cost segregation this year, even though my rentals were purchased 5 years ago. I can do a catch up. Now, if I'm trying to use it on 2023 tax return, then I have to do it before I file my 2023, right? So hopefully I'm on extension or I got to do it before October 15th because that's when my return is going to be due.
Yeah, makes sense. Okay, I'm going to use a real client case study I'm working with. Okay, he's on the verge of buying that another female investor I'm working with also buying multiple units this year. So these two investors, before the year is over, they're going to have like 10, let's say 10 rental property easily. And they do not qualify as a risk professional status. They make more than 150K. If they were to do cost segregation and accelerate those in getting a lot of suspended benefits, then when they buy more rental properties with the cash flow, that rental income cash flow properties can offset by the other passive losses they gain through cost segregation or even without it. So it still makes sense for them to do cost segregation. Because the other
that's a good example of the timing of it, right? So if this year they don't have passive income, all they have are losses, they're not real estate professional, I would just take regular depreciation. And then in your example, in 5 years, they have all these properties, they're all cash flowing really high. Now I have to pay tax on my rental properties. At that time is when I would do cost segregation, maybe on my whole portfolio, right? So I wouldn't do a cost segregation before I can use it. I want to do it in the year where I can actually use it against my income. So if this year I don't have passive income, I just take regular depreciation. Next year I have positive taxable passive income, then I'll just cost seg next year.
Wow. Okay. That makes sense. Very good answers and solutions. I really appreciate that. I think we're almost time's up. One final question. I have to say, I say to myself, if someone are buying a property that are less than $400,000 or even $500,000, maybe they should not do a cost segregation because I don't know how much it costs. And each firm is different. Some charge $3,000, some charge $4,000. You have to use a cost benefit analysis. You're not going to go out there and buy a small little rental in the Midwest for $100,000 and do a cost segregation because the cost benefit doesn't work. The fee you pay to do the cost seg study will be much higher than this tax savings from the cost seg. Am I right? Is there such thing as a threshold where you can justify do a cost segregation? Like, for example, like a $500,000 purchase, is that a good threshold to justify to pay the cost of doing the cost seg?
Yeah. So the answer is it depends. It depends on so many different factors. And the good news is you can find out the answer to that question before you actually pay for cost segregation. All it takes is working with your CPA as well as a cost segregation firm to figure out what that benefit is. So I know you said in your example, if I bought a property for $150,000, maybe it's not worth it for me to do a cost segregation. Maybe it still does, right? If you're someone who makes $100,000 a year, you have a $150,000 rental you bought. Let's say the building itself was $100,000. Maybe if I can pull $10,000, $15,000, $20,000 of depreciation and save $2,000, $3,000 in taxes, it's still worthwhile for me if it's going to cost me $1,000 to get it done or $500 to get it done. So it just depends on the numbers. We have a client who has, over 100 single family homes. Each of them are under $150,000. And does cost segregation make sense for them? Absolutely. Because when you look at the portfolio and you look at the fact that their personal tax rate is 37%, it makes it a no-brainer to do it. There's not a one-size-fits-all solution where, oh, if it's 100,000, I'm definitely not interested. It's 500, I'm definitely interested. It depends on the property. How much is the building? How much is the land? And it also depends on the taxpayer's tax rate too. And also the third thing is $150,000 property on Main Street, our result might be very different than $150,000 duplex by the lake, right? So each property profile is different as well. And again, how do you know whether to do it or not? You just get the help of your CPA and you get a free estimate from the cost seg firm. Then you get to decide before you even pay them to do a study or not do a study.
Very good point. I think we're pretty much almost running out of time. I would love to talk forever. We are very busy in our respective professional lives, and I really appreciate you coming on board. And then, of course, we don't have time to talk about the real estate professional status or short-term tax loophole. That's in the future. But that's enough for right now. And you have any final thoughts before we conclude this podcast?
If any of the stuff that we said was new to the audience or newer to the audience, or like you said, if you want to know more about what is real estate professional status, what is the short-term rental loophole, you can go to my firm's website. We have a free tax savings toolkit where we go pretty in depth about both of those concepts and some more stuff. I also wrote a book. It's called Tax Strategies for the Savvy Real Estate Investor. If you want some fun nighttime reading about tax strategies, you can find that on Amazon, Bigger Pockets, and also anywhere books are sold.
Amanda, actually, I purchased your Advanced Tax Strategies book
I went straight to the advanced version.
And I read it a year ago and I digested more than once. I love your books because it's very practical. It's not too technical and you use case studies, examples. You know, most professional financial books, they're over people's head, right? I mean, they just legal jargon, tax jargon, everyday people don't get it.
Awesome. Well, thank you so much for having me.
My investors, if they need to contact you, I have the registration link all set up to send to you. So no need to provide any contact information because I have it already for my members. Thank you so much, Amanda.
Thank you.
I appreciate it. Looking forward to working with you. Great.
Yes, you too. Thank you. Bye, Seewing.
Yeah, same here. Bye-bye, Amanda.